Welcome to the second quarter market review and investment forecast. My name is Stacy Francis, and today we're going to be going over in 30 minutes or less everything that you need to know about what's going on here in the second quarter and coming up to the third quarter and fourth quarter of 2019. It's been quite a ride, and I'm very excited for Avni and I to take you through that. So without further ado, let's get started, let's get going, and let me introduce you to one of the VIPs here at Francis Financial. Omni Ramani is the Director of Financial Planning and Wealth Management here at Francis Financial. And as you know, we're a boutique firm that offers advice to women going through transitions such as divorce, widowhood, or sudden death of a partner. We also work with wonderful couples who are planning for their future, both for retirement and also potentially for sending their kids to college, maybe a vacation home, and living the best life possible. Avni is a certified financial planner. She's also a certified divorce financial analyst, and she's also a grief recovery coach, which you may not know about her. She's been quoted in many different publications, CNBC, The Wall Street Journal, Forbes, Bloomberg, Investment News, just to name a few. She's also active in the world of ongoing continuing information and education. She's the director of the National Association of Divorce Professionals, Manhattan chapter, and she also organizes, also volunteers and at many organizations such as High Water Women, as well as my personal favorite charity, Savvy Ladies. So without further ado, I'd like to introduce Avni.
Thank you, Stacy. And I'll return the favor. I get the pleasure of introducing someone who needs no introduction, Stacy Francis. Of course, she is the founder and CEO of Francis Financial. And in addition to being an extraordinary leader, she is a nationally recognized financial expert. She is in the press extensively on national media, including CNBC, Wall Street Journal, Forbes, and many, many others. She also has some really prestigious awards to her name in the financial planning industry. She has been recognized as the top 10 financial advisor in New York by Advisory HQ, top wealth advisor moms by Working Mother magazines. And we recently had another award from the Investment News magazine, and there are many others. She works, Stacy Francis, as you know, works tirelessly to help women going through transitions such as divorce and widowhood. And in that effort, she is also the dynamic host of our podcast, Financially Ever After, that hosts women going through divorce and also divorce professionals that help people going through this difficult process of divorce. And I turn it back to Stacy to continue with our market review.
Thank you, Avni. I'm very excited to be here today, and we're going to just jump right into the market review. We're going to talk about the second quarter of 2019, and just to put it into time frame again, that's April, May, and June, those 3 months, considered that second quarter. And I have to tell you, it was quite a quarter. All asset class, as you can see here, both U.S. stocks, international developed stocks, emerging markets, as well as U.S. bonds were up during those 3 months. The ones that really brought home the bacon, U.S. stocks brought home a 4% return, which is phenomenal in only a 3-month period. Also, international developed stocks, and that also includes those Brexit countries, such as the UK, and its influence in that part of Europe. And even with that hindering some concerns about that area, you can see that international developed stocks did phenomenally well, up 3.79%. The other winners, U.S. bonds. That's a really nice reward that we have from our bonds. Typically, we wouldn't expect returns quite that high from bonds because we really use those bonds more so as an airbag, a cushion to our portfolio. And even emerging market stocks were up too. Very happy about that. Now, it's great to look at things for the quarter, but let's be real. You really want to look at longer time periods. And so we put together this chart, a 1 year, a 5 year, and a 10-year look. And what you can see is that all of the asset classes have really had phenomenal returns. And let me just go ahead and show you. So for US stocks, it had almost a 9% return over the last year. The last 5 years, over a 10% return each year. Again, remember each year over the last 5 years. And look at that 10-year, almost a 15% return. And I will tell you, while we'd love to see 15% returns across the board, one of the best things about this chart is actually the variance in returns, the difference of returns. And if we go to, for example, that 10-year, you'll see that almost 15% return each year from US stocks. International developed has done very well, 6.75%. Emerging markets has done very well too, 5.81%. And even bonds have not been lackluster. They have had a return of almost 4%. Now, the reason why we celebrate the variance, the difference in returns among these different areas of the stock and bond market is because we don't want to necessarily see things move lockstep together. Why? Because if they move lockstep together, we know that if there's a downturn, bless, everything would lose. And that's not something that we really want to have. I mean, what would be the point of diversification? Now we're looking at 1 year, 5 year, and 10-year. We went even back further. We actually went back to 2001. And 2001, just to give you an idea, is a very special year for me because that's the year I got my certified financial planning designation. And it was really one of the most exciting years of my life. Well, we went all the way back to January 2001, and we looked at, well, on a quarterly basis. So, if we were to look quarterly, what was the average return quarterly from each of these asset classes? And the reason why we wanted to show you this is that if you remember this chart right here, what performed the worst out of all of the stocks in pretty much every time period? Well, it was emerging market stocks. And emerging market stocks, that is Brazil, Russia, India, China, those countries, for example. But if we look at going back all the way back now, literally 2 decades, you can see the highest performing of any of those areas is actually emerging market stocks. On average, they've had a return of almost 3% each quarter since 2001, where you can see US stocks have actually trailed below that. Still not bad, but trailed where emerging market stocks were. So, what is the story that we're talking about here? And why are we showing this? Well, it all depends on when you start counting of whether or not international emerging market stocks did better or did not. And the reason why I bring up international right now is because there's a lot going on with the news, with the media. In fact, let's go ahead and do that. We're going to jump first into US stocks, and then we're going to take a look at the outside arena of other pieces that are moving and having an impact. So US stocks, we look at it two different ways. You can see the first section right here, the first quarter, it was a pretty heady first quarter of the year. Talk about bringing in the new year with a bang. You can see that during that first quarter, January, February, and March, stocks returned almost 14%, 13.7%. A phenomenal return, especially for 3 months. But the news continued, the good positive news still continued, even though it was not quite as heady in the second quarter. US stocks had a return of about 4.3%. Where are we at so far year to date? Well, as of the end of the second quarter, we were up nearly 20%. You can see 18.5%. And we're cautiously happy to see this trend. But what are the main drivers? What are the drivers during the second quarter that we saw impacting the US stock market? There are two. And the first that we're going to be talking about is China and the US. Essentially, as you know, trade negotiations. Well, overall, during the second quarter, we saw positive steps, or at least what we could say, not necessarily steps backwards in the trade war negotiations. And because of that, during the second quarter, that essential April, May, and June time period, we saw the US stock market react pretty favorably. And that is one of the reasons, again, why we saw such a real strong second quarter of 2019. So, what's that other factor that I promised to tell you about? Well, it's the first rate increase, the first interest rate cut that we've seen since the Great Recession of 2008. On Wednesday, August 31st, the Federal Reserve lowered interest rates for the first time since 2008. Now, why is it? Well, it really was meant to help stave off the possibility of an economic downturn, essentially cushioning, giving additional robust protection to the US economy to really deal with the volatility with the news politically and economically that are influencing and potentially could be a headwind for the US stock market going forward for the rest of this year and into next year. So essentially, it was seen as a precautionary effort to really protect the United States from the slowing growth that we are hearing about in China, as well as in Europe, as well as President Trump's trade war that, as we have seen in the news recently, has become the dominant headline. But what does this mean for you other than the stock market has a little bit more tailwind boosting it forward, going forward, hopefully? There are a few things that you need to know about for your personal finances. First, what we talked about. Now, even though we've seen the stock market take a dip over the last few days, this move by the Federal Reserve should again help boost the stock market to continue to reach new highs and gains moving forward. It's giving it more of a ability to do that by having that stimulus of lowering of interest rates. The other thing it means for you, well, if you're buying a car, it means that the interest rate that you're going to pay is a lot less. And this is a beautiful car. The reason why I put it in this presentation is that this is the car my husband had when we met 20 years ago. And needless to say, we do not have a car like that anymore. Bless, he ended up marrying me, right? So we don't have a car like that anymore. But needless to say, getting in that car, you don't realize how close it is to the ground. I actually gave myself a herniated disc getting in and out, if you can only believe. But if you are buying a new car or you're leasing a new car, the good news you're going to see is that eventually interest rates and the cost of that lease should go down for you. Same thing with mortgage rates. Mortgage rates we will slowly see tip down even more so. So if you're buying a new home, good news for you. Also, for those of you who may not have refinanced and were late on the game for that, well, guess what? You have another opportunity to refinance at a lower rate to lock in lower interest rates. And finally, credit cards. It will take some time for this to trickle down to credit cards. Right now, we're still seeing an average credit card interest rate of about 16%, which is a whopping high rate. So slowly you should see those rates come down. But the other thing you can do is you can also call your credit card company. You can ask them to reduce their rates. And more importantly, you can demand. If they don't, you'll move to another credit card. We can talk about the personal planning, particularly for you, during our next check-in call, but these are some of the financial planning pieces that you need to think about and the benefits of that interest rate cut for you. So what about stocks? Are they still overvalued? Well, everything that we're seeing right now with the drop in the stock market over the last few days, for us, well, we're not necessarily concerned about that because US stocks are still considered overvalued. And how do you tell that? Well, we look at its price to earnings ratio. And essentially, the average price of US stocks going back over the last 10 years has been 17.86. This is the average over those last 10 years. And you can see where we are trading. We're trading above that 10-year average price to earnings ratio. So based on that, what it's telling us is that actually US stocks are somewhat overpriced versus historically what we've seen. So the drop in prices, the drop in the stock market that we've seen over the last couple days is not necessarily a bad news in the sense that we expect the market to rebound, but it's also not bad news because it's giving us an opportunity to potentially be able to get some good deals. Get some good deals, essentially US stocks potentially here on sale, which is great. So the other thing that you may have heard about is in the news is gross domestic product. Essentially, gross domestic product is a fancy way of saying how fast is an economy, a country growing. And for the US, we call this our GDP. And we've talked a little bit about this before. We're seeing that there is evidence that gross domestic product growth of the United States economy is potentially going to slow over these next 2 quarters. Now, what I think is really very important for you to know is that we're not saying that growth is going to stop. We're saying that there could be a slowdown. We're not saying that it's going to be catastrophic, and we're definitely not saying the R word. And if you're not sure what that R word is, the recession word. We do not see a recession anytime in the near horizon. Now, why are we seeing the potential why that there could be a slowdown in America's growth? Well, because we're a little bit tapped out. Where we are with unemployment, unemployment is at historic lows, nearly as low as it could possibly go. And so there's not as much room for more individuals to be hired. And what ends up happening when more individuals are hired is that income goes up. And as more dollars go into the pockets of consumer, what do? Well, we spend it, let's be honest. Hopefully we save some, but we also spend it. And when we spend more money, well, there's more demand for goods and services. And the growth of America, GDP, goes up. So that's part of the reason why we expect that there might be a little bit of a slowdown. Also, the tax cuts that we saw previously the last couple years, well, a second round is pretty unlikely. And those tax cuts, however you believe, whatever your political inclination is, what we do know is that it definitely has spurred on our economy in many ways. And going forward, again, we don't necessarily expect those tax cuts to be hitting us moving forward. So one of the things that you may be thinking about, specifically with the trade war, with unemployment not really able to reduce anymore to spur our economy, that we're being really kind of at the floor already, and the fact that most likely there's not going to be any type of tax cuts to help spur our economy, what should you do now? Should you change lanes? Should you change the way that you are investing your money? Well, let me tell you a story. Over the weekend, I was fortunate enough to go back out to Michigan, where I grew up. I flew into Chicago and went on the Chicago Skyway. Well, if any of you know the Midwest, in particular Chicago, you'll know that the Chicago Skyway is one of the most traffic jam prone roads in the United States. Well, guess what? That's exactly what happened to me. I got stuck there and it added a good 45 minutes to my commute. And what I remembered from traveling and from also driving is that the more you change lanes, more likely you are to get in an accident. So I was very careful and I made sure that I stayed in my lane, and it reduced a lot of my anxiety of just staying in my lane, making it through, knowing that if I was going to change lanes, most likely it wasn't going to help. If anything, it would have only increased my anxiety and only increased my chances of an accident. Now, the reason why I bring this up, you may be wondering, but the reason why I bring this up is that this is exactly the same philosophy that we know and is proven that works with investments, staying in your lane. We do not recommend timing the market and trying to pick this asset class of small company stocks versus large company stocks and really switching between them because of what's going on in the economic world arena. It's one of the most dangerous things that you can do with your portfolio. And what we have found is that changing your investment mix of stocks and bonds is treacherous. Doing it according to short-term time frames, we see that those people that are the traders that are trading most frequently are the ones that underperform. It doesn't mean that you don't put a wonderful, robust portfolio that's right for you, a mix of stocks and bonds to get you to your goals long term. It doesn't mean that you don't do that and potentially shift it through time, but not based on outside external events called market timing. Because again, market timers lose out. And just as those people who race between lanes and more likely to end up in an accident, we see those people that race between lanes of switching in and out of asset classes are those two that end up with an accident with their portfolio, essentially a collision with their portfolio. So without further ado, now that you guys all know about my driving habits, I'm going to move it on to bonds. And staying with the theme of driving, we're going to be talking about bonds being an important part of your portfolio, essentially the airbag to your portfolio.
Hello, I'm going to start with the bonds portion of the market. So just continue from where Stacy left off, and then talk a little bit about what happened in April, May, and June in the bond segment. As Stacy mentioned earlier, the Federal Reserve just reduced interest rates, and how that helped the economy and what that's supposed to do. Now, the Federal Reserve did a little bit of a flip-flop. So if you recall, towards the end of 2018, the market, the general market experts expected these rates to increase over 2019 and 2020. They were expecting at least 3 increases over the 2-year time frame. And then in the beginning of 2019, in the first quarter, the markets expected rates to mostly stay steady in the 2 years with no increases or decreases. So the experts seem to think that, hey, what we were thinking at the end of 2018 doesn't hold true anymore, and maybe the rates will stay steady. Guess what? At the end of the quarter in July, the end of July, there was a complete reversal, and the experts came out and were proved wrong when the Federal Reserve dropped the interest rates. And now the experts seem to think that they'll continue to go even further down in 2019 or 2020. So, the experts are adjusting, they're following what the Federal Reserve is doing, and are not able to really predict, which is what we say even in the stock market side. No expert can consistently, over a long period of time, predict what's going to happen in the market. So, of course, we have no control over what the Federal Reserve does, but that is why we recommend to stick to your lane, as Stacy was just mentioning. If we look at what impact this has on the prices of the bonds, so when the interest rates are lowered, so for example, if we have the interest rates right now, for example, if they were at 5% and the bond price was $1,000, what would happen if the interest rates increased to 5.5%? What the impact that has is that the people holding bonds will want to sell their lower interest 5% bonds and buy higher interest 5.5% bonds. But the people who are buying the bonds may not necessarily want them at that price. So what happens is that the bonds, then the holders of the bonds are forced to lower their price in order to be able to sell the bonds. And therefore, bond prices decrease. So they may come down to 900 or so. And this is just an example. This is not the exact way bond prices will move, but this is just an example of showing that when interest rates increase, bond prices tend to come down. And the reverse is true when interest rates decrease. So if interest rates were to, for example, go down to 4.5% in this case, in order for the, so the 5% bond becomes more attractive, and therefore others are willing to pay more for that 5% bond because everything else now is offering only 4.5%. And so the buyers are willing to pay a little bit more. And that's how bond prices increase when interest rates drop. So what we're going to see now with this interest rate environment of decreasing rates is that the bond prices will continue to rise. And that is why we saw in the beginning of the year, the first 6 months of the year, bonds increasing in prices, and also taking into account that shorter term bonds have more of an increase because you're able to sell those out sooner. Now let's look at what happened in international stocks. Again, the theme of the quarter was that all the segments of the market increased, and so as did international stocks. So if you look at emerging market stocks, these are all the emerging market stocks, and together they gained more than 10% for the first 6 months of the year, which is a very, very impressive return. The developed international markets, which are more, Europe, parts of, Europe and Canada, Russia, Japan, Australia, all these markets together were up 14% for the first 6 months of the year. So very impressive growth there. If you look at individually, what happened in each market had a very wide variety of returns. And some of these returns that we see had positive returns for 2 straight quarters. So, but it all really depends on where you start, from where you start counting. Going back to what Stacy was mentioning earlier. So if you see here, Switzerland had an 8.41% return, which was the highest, and the Hong Kong was less than 0.5% return. So our philosophy of diversifying again proves true, where you can't focus on any one country of the world. You have to go across, because you don't know which country will outperform the other over the course of the time frame. Some of the things that helped the developed international markets was the strength of the European Union. There was a large news coverage around Britain's exit from the European Union, but in the recent evidence shows that the economies of the countries in the Eurozone are doing really well. The unemployment is falling and wage growth is continuing to pick up. So the European Union, the economies in the European Union are continuing to do well. What happened in the emerging markets? These are some examples of the emerging markets, but largely, when you think about emerging markets, think about countries like Russia, India, China, Brazil, but there are so many others in there as well. There was a wide range, as you can see. Pakistan was a negative 21.22% in returns, while Greece was a positive 23.44% return. Again, a wide variety, but together, overall, the emerging markets were up 0.61%, which was a modest return compared to the beginning of the year. January, February, and March were much, much higher. But Q2, the emerging markets held their ground. Again, going back to the diversification, where you don't focus on any one country, but across the entire spectrum of countries. The emerging market segment particularly were weighed by the concerns of the trade wars. The end of the quarter was particularly rough, and then now in the beginning of the quarter, we're looking at a lot of news coming out about trade tariffs and devaluing of the Chinese currency. There is a lot of short-term anxiety in the market, but if you look over the longer period of time, these things do have a tendency to settle down. If you think with a cool head, the 10% tariff on $3 billion worth of exports is a drop in the bucket compared to the $2.5 trillion export that the US has across the whole world. So we really should keep this news that comes out in perspective. In fact, I would say that this could lead to a buying opportunity in this segment. If emerging markets fall a lot, and even if that impacts the US markets too, I would say this would be an ideal buying opportunity for smart investors. So keep that in mind as you consume the news coming from the media. Even international stocks are a better buy than US stocks, and because of their price to earning ratios. We've been talking about price to earning ratios in our previous webinars, but it is the price that someone is willing to pay, an investor is willing to pay for a stock based on the capacity of earnings that that stock has. And it looks like the price that people are willing to pay for US stocks right now is much higher, even though the earnings expectations do not justify that price. If you compare that to international stocks, the prices that investors are paying are much lower compared to the earnings expectations of those stocks. So those stocks, international stocks, are right now looking much cheaper compared to US stocks. So that's a great opportunity for smart investors, long-term investors, to buy into a market that has a lower price. One of the big factors that everyone's been talking about is the dollar, the strength of the dollar compared to other currencies. When the dollar is weaker, it actually helps international stocks because you can buy more stocks for the same amount of dollars. And we anticipate one of the big focus of at least the Trump administration is to weaken the dollar. And that's why there was so much irritation on the administration's part when news came out that the Chinese currency has been devalued. It means that they need to now do more to keep the US dollar from strengthening too much. So we do see that in the longer term, efforts will be made to keep the dollar stable so that it's more attractive for other countries to buy goods from us. This will continue when other countries are willing to buy goods from the US, it will keep production up and therefore growth up, and then as Stacey talked about, the gross domestic product, it will keep the GDP up as well. So I'm going to pass it back over to Stacey as we approach the towards the end of the webinar, and Stacey can talk more about the exciting things going on at Francis Financial.
Thank you, Avni. Thank you. This is I want to talk a little bit about our second opinion service, and you may or may not know about this. And most important, for those people who are not already clients, it's a wonderful way that you can be 100% sure that you're on track, you're on the right financial path. And why is this important? Well, according to the Wall Street Journal, 80% of individuals that investors would value a second opinion. And that's actually what we offer. It's a full analysis of your financial holdings, every single mutual fund, exchange traded fund, stock, and bond, and really looking at each piece to see not only each individual investment, but how they all work together. And most importantly, if you are on track to achieving your goals, if this is the right portfolio, if it has enough engine, if it maybe has too much engine, it helps you know where you stand. And studies show people who have more information, that are in the know, fare better with their finances long term. And you can see it will help you at no cost know whether or not you are on track to reach your goals with retirement, with sending your kids to college, and potentially even just living the life you want to live. And that could be with more travel, it could be more experiences. And you can trust us because we're independent, we're fiduciary, and we put your interest first. We've also been blessed enough to receive many outside awards and accolades from CNBC, from the Pro Bono Awards, Medical Economics, as well as a top advisory award for our work specifically with women. And what I want to tell you, some information that is actually right hot off the press. You may have seen it on our Facebook. We just received another award last week, which I'm very excited about. Investopedia went and released its top 100 financial advisors in the country, and we made that top list for 2019. And the reason why I'm so honored by this is I know who those top advisors are, and I was so excited to see many of their names from other parts of the country. So it's really a wonderful, wonderful celebration. So thank you for thinking of us. If you know of anyone that could benefit from a second opinion, please do reach out. I've included our website, our Twitter, our Facebook, as well as our amazing team there. And most importantly, from Avni, as well as from myself, I want to say thank you for investing in yourself and taking the time to educate yourself about investments and your portfolio. This time that you're spending educating yourself is one of the most worthwhile investments you could ever make in yourself, in your family, and really in your financial future. So please do reach out to Avni or myself if you have questions about your own personal situation, or if you know someone else that is as nice as you, they have to be as nice as you, that could benefit from that second opinion with a better view into their overall financial picture. So thank you, and thank you, Avni, for joining me. I've had a ball.
Me too. Thank you.